Indicating to our viewers that we would be covering the mega Morningstar annual investor conference, and now it's the big day. The top team is there with us, Kunal and Aditya. Gentlemen, you put a very impressive guest lineup. It's a good show, so congratulations once again, Aditya. Your team has really worked hard to put this grand show. And Kunal, fantastic to have you back in India.
Yeah, thanks for
Good to connect
putting
with
me
you.
here again.
So Kunal, 2 years ago when we met, it was all about emerging markets. It was all about ETFs.
Yeah.
And it was all about saying goodbye to US equities.
Yeah.
But the reverse seems to be happening. Emerging markets are in a downturn.
Yeah,
Passive investing has made a huge comeback, and Indian US markets continue to rise and shine. So
Yeah.
what's going on in the world?
yeah. Well, I think really if you look at things from a longer term perspective, I think clearly the US has done quite well and the dollar itself has been very strong. And so that explains a lot of the returns. And usually when the dollar is strong, you get pressure on emerging market equities. But I was saying yesterday when I was on ET as well that sometimes it takes longer than you may think for a cycle to change. And certainly if you look at what our analysts are saying, on a relative valuation basis, we're finding fewer opportunities in the US today and more opportunities outside the US. That includes emerging markets for sure.
My immediate follow-up question would be that this is the longest bull market in the history of American equities after
Yeah.
the Second World War.
Yeah.
You look at the concentration. The concentration is centered around just four names: Alphabet, Facebook, Amazon, and Netflix.
Yeah.
If I talk to an average American investor, there is no skepticism, there is no cynicism, there's only optimism. It's just feeling like there's a carnival which is on.
Yeah, well, I don't think it's quite that extreme, but certainly, you do have a bifurcation that has taken place in the U.S. market. But I don't think we should underestimate the meaningful impact of the tax cuts on the U.S. I think that has certainly been a very big positive this year for U.S. equities. But clearly going into next year, that tailwind is not there. And then certainly, if you look at it from a valuation perspective, you're starting to see some pretty significantly silly valuations in certain segments of the market. And even the pullback you had, what was it, 2 weeks ago or so, you saw some really rapid movements in some of the technology names that had moved up. But the reality is that, relative to some of the dot-com technology companies, the stocks you named, at least the majority of them, the Apples, the Facebooks, are generating a lot of cash and are a lot more positively inclined from a profitability perspective than the technology companies of yesteryear. So they're great businesses. The question is, are they good values at this point as well?
Aditya, I'm just wondering who's got a tougher job, Kunal or you, right now, because it seems like he's sailing on that Titanic, but for us, our boat is already beginning to rock a little bit.
I won't say that our boat is rocking. I think we're doing the right things for the investors. We are talking for the investors. We stand for the investors. I think we
No, I'm talking about the markets purely. I'm not talking about you and your investors here.
Okay.
Yeah.
Yeah, so I think the markets, we have to look at it from a longer term perspective. Markets have been rising for the last 3-5 years in India as well. Yes, we have seen some 15-20% of contraction this year, but I think we want to encourage investors to think long term and to stay put in equities over a longer term. So I think that this could be just a good opportunity to buy, in fact, to add more value.
Easier said than done though, but in the near term, do you believe that the concerns are large and we may not be done with the pain quite just yet?
So it's hard to kind of say that, but I would advocate that there are some pains in the short term, but with the elections coming up and with
Crude.
kind of
Yeah.
so the crude has definitely been a spoil sport, but I think it's a good time to add and find value in the market.
I always say this that good news and good prices, it rarely comes together. A year ago there was only good news, prices were not great. Right now there's only bad news. So we are perhaps reaching that level where prices are becoming great. Kunal, the big change in last 2 years has been that cash in America now is giving a return, and it's 3% plus.
Yes.
Now that means that bonds will compete with equities.
Yeah.
Equities will get competition from bonds or from cash.
Yep.
And that again goes back to that whole basic thesis of active versus passive investing. Because if cash is giving you 3% plus, that's a big setback for the so-called ETFs now.
Well, I think it's less so about the active passive and just the reality that the risk-free rate starts to, go up. And so from the perspective of how you discount and look at your modeling of individual equities, it becomes that you have to clear a higher hurdle in general. But I think as it pertains to passive and active, the real challenge there, and you've kind of said this, is, one is expenses have continued to trend lower on the passive side. The reality is that, zero expense offerings are likely going to happen in the US, and that's pretty dramatic if you think about the fact that you can basically invest at no cost. And then, I think one of the challenges for passive, which you've highlighted already in your earlier comments, is that a lot of the indexes are increasingly owning larger shares of some of the companies that you highlighted. And so we'll see if in fact some of those companies turn out to have been overvalued, then that could be an opportunity for active managers to outperform, although it should be said that active managers own lots of Apple and Facebook and names like that as well. So it's kind of an interesting juxtaposition.
Lots and lots, and sometimes only just that.
Yeah, but I
That's the
think
biggest
this is
fear,
why
right?
if you're an investor, sometimes as fun as it is to look at things on a day-to-day basis, it's really best to use strategies like dollar cost averaging or rupee cost averaging and using strategies like that, so you're not as beholden to the swings in the market, and you're really building wealth over time, which is really what investing is about.
Aditya, you said that you are finding opportunities in the market. Where do you believe that opportunity is?
Well, I think the way we look at it, the investor need to kind of stick to the asset allocation that suits the risk profile, and kind of make sure that they are buying at every dip. So systematic investment plans are making sure that there is an opportunity. Whenever there's an opportunity, you are adding more to your portfolio.
Yeah, one of the names that our analysts like here in India is Escorts, and they like Escorts because they view it as a pure play agriculture name, where they think the cycle is going to be long, and as there continues to be automation in agriculture, that's kind of a long-term trend you can play, and so they like Escorts as a pure play trend in that area. So that's one name we'll be talking about today.
I'm sure Escorts is not the only name your analyst likes,
Yeah,
right?
yeah.
Which are the other names?
That's the one I came prepared to talk about.
Tell us more.
Aditya, the new mantra with investors is mutual fund sahi hai, right? Up until now, it's looking good because if you look at the 3-year return for equity diversified as well as small cap schemes, have given a positive return.
Yeah.
But another 5% more for large caps, another 10% more for small cap. The 3-year story, the 5-year story will have a big scar, so to speak. Could that change the way how the SIP movement in India has taken momentum? Because a typical investor would look at track record and past performance to judge the future. That may not be an excellent strategy. We both know that, but that is how an average investor historically has approached equity as an asset class.
Yeah, absolutely. And I think that's where the value of advice comes in. That's where the advisor needs to handhold the investors and be able to encourage the investors to stay invested. Of course, another 5-10% of contraction and maybe the returns are negative or the returns kind of just even out. But I think that these are the times to buy.
So Escorts is just one side of the story. It's the whole rural agri push that you're betting on. What else?
One name that our analysts don't like as much right now is Nestle India, and we'll be talking about that as well. And that's purely a valuation call that they don't find that the valuation is particularly compelling at this point.